Yeah, and while we're reading through the book, like, you know, definitely if you're having the slightest misunderstanding of the concepts that we're discussing in the book, like, bring them up in the Discord, I mean, everyone will help out. You know what I mean? I'm not gonna fucking, I'm not gonna shut anybody down and be like, "Oh, that's a stupid question." It's just not who I am. As much as as much as like maybe that's a good quality, I just don't have it in me. All right, well, let's get started. We're gonna pick up where we left off. We're reading Mind Over Markets. This is part 7. Welcome, and if you have any questions, feel free. Gaps. The last special situation that we will discuss is the gap. A gap is an opening outside the previous day's range, signifying a market out of balance. A gap is created when the other time frame perceives price to be away from value and enters the market aggressively, forming excess in the form of an invisible tail. The salient feature of a gap that holds is that it should offer significant support or resistance to price, and it therefore stands as a valuable guide for day traders and an important reference point for long-term traders. Gaps fall into 3 broad categories: breakaway gaps, acceleration gaps, and exhaustion gaps. Briefly, a breakaway gap occurs when the market is in the early stages of a long-term trend. This sort of gap is fueled by a new initiative, other time frame participants possessing strong directional conviction. An acceleration gap develops within a trend and reaffirms that the conviction and strength of the trend's direction. Finally, an exhaustion gap will sometimes mark the end of a trend. In the final stages of a buying trend, for example, more and more participants gradually convinced that the market is indeed trending. Eventually, practically everyone is a buyer. The final consensus is so strong that the market gaps higher and the last doubters jump on board. Once everyone is long, however, there is no one left to buy, and the trend is effectively over. Whether or not a gap is a breakaway, acceleration, or exhaustion gap will greatly influence the likelihood that it will hold. However, what we are concerned with here is the special situation properties of a gap. Thus, the following discussion treats all gaps the same by evaluating each in the present tense. Daytime frame significance of gaps. Generally speaking, most gaps are eventually filled, some on the same day. In the day time frame, if a gap is going to be filled by responsive participants, the rejection will usually fill the gap within the first hour. There you go, that's what we were looking for yesterday. The longer a gap holds, the greater probability of continuation. The special situation rule for trading gaps is to trade with the initiative activity that caused the gap, placing stops at the point where price rotation would effectively erase the gap by trading completely through it. Figure 4.113 represents an ideal gap trade in crude oil. Shorts placed in the first half hour of trade with the gap lower and subsequent open drive activity resulted in good trade location during a selling trend day. Shorts should have been exited if price had filled the gap by trading back above 1992. Not all gaps are quite so ideal, however. Like the value area rule, there are outside factors that influence the way a gap should be traded. In figure 4.114, the Swiss franc opened 26 ticks below the previous trading session's lows. Such an extreme gap should have alerted traders to the possible entry of the responsive buyer. The further away from the previous day's range a market opens, the greater the likelihood that the market has temporarily overextended itself. When this occurs, the responsive participant will often narrow the gap by auctioning price towards the previous day's value. When the market gaps significantly away from the previous day's range, the prudent action is to monitor activity soon after the open before placing trades. In the case of the Swiss franc in figure 4.114, if the responsive buyer enters, traders should wait until the initiative seller reappears, monitoring the gap for support. When responsive activity waned and two time frame trade developed with the downward rotation in A period, shorts should have been entered and buy stops placed at 59.87, the gap erasure point. Again, successfully using special situations involves a synthesis of market understanding, time, and experience. It is difficult to explain the ideal point at which a gap trade should be entered. In many cases, blindly placing a trade in the direction of the gap will eventually result in a successful trade. However, without monitoring earlier activity, a trade placed too early might suffer undue exposure if price temporarily auctions against the position. Starting out with poor trade location can be both financially and mentally taxing, often to the point that the trader is forced to exit what would have developed into a good trade. Our Swiss franc example provides a good example of how this can occur. A trader who sold immediately with selling gap could have easily been forced out of his or her short position, given the Swiss franc auction against the position for better than the first half hour of trade. Traders who anticipated responsive buying after such a sharp break from value would have probably waited for a return of the selling auctions before entering shorts. With the responsive buying over, at least temporarily, traders placing short positions would have had more confidence and therefore a better chance of completing a successful trade. In this case, notice that both scenarios would have ended in a similar trade location. The difference between the two trades is the level of accompanying anxiety. Figure 4.115, a filled gap occurring in June gold, April 28th to May 1st, 1989. Gaps do not hold every time. On some occasions, the buying or selling auction that produced the gap will fail, inviting responsive participants to return price to the previous value. When this occurs, however, there are usually clear signs that the gap will be erased. In the case of the gold market in figure 4.115, gold gap below the previous day's range. After a quick test to the downside, the responsive buyer entered and drove price up through the gap into value area of April 28. All of this activity occurred during the first half hour of trade. Traders who sold the selling gap should have covered when gold auctioned above 379.60 in Y period. Gaps are created by aggressive other time frame activity. They are significant reference points as long as they hold. If, however, responsive participants overcome the initiator and return price through the gap, then conditions have changed and the gap is no longer a significant trading guide. Summary. Special situations are not fail-safe answers, but they do offer a trader some degree of comfort and security. Still, your imagination should not stop at these limited examples. By incorporating the different methods for evaluating directional conviction and performance, a trader can identify other circumstances that offer high leverage and low risk. To put it simply, the big picture is made up of many small, more specific components. By synthesizing these factors into a more all-encompassing market understanding, you will increase your chances of success. Consistently successful trading is the result of a unique combination of opportunity, experience, and market understanding. Markets to stay out of. Special situations are useful for identifying trading opportunities that possess relatively high degree of security. On the opposite end of the spectrum, but no less important, are those times when one should simply not trade at all. A trader who forces a trade when there is no real opportunity in the market is like a basketball player who forces a shot when he is off balance, he or she is off balance, or heavily guarded. The chances of scoring are low. A good basketball player who does not have a clear shot will generally not shoot the ball. Similarly, experienced traders who do not see a clear market opportunity do not force the trade. The harder you have to look, the lower the potential for a good trade. In such a situation, it is best to stand aside and wait for an opportunity to develop. The following discussion covers 4 market situations that signify the existence of relatively little trading opportunity. 1. Non-trend days. 2. Non-conviction days. 3. Long-term non-trend markets. 4. News-influenced markets. Figure 4.116, a non-trend day occurring in June Treasury bonds, May 8th, 1989. Non-trend days. The most obvious market to stay out of is a non-trend day. On a non-trend day, the market is not facilitating trade with any participant and opportunity is low, where the day's range is small and activity is scarce. Figure 4.116 shows a typical low-volume non-trend day that occurred in bonds on May 8th, 1989. Non-conviction days. A less obvious type of low opportunity market is a non-conviction day. Structurally, a non-conviction day often appears to be no different than a normal variation or neutral day. However, the non-conviction day exhibits none of the other time frame directional conviction that these standard day types typically display. There are no recognizable reference points for a day time frame trader. During a non-conviction day, the open is often of the open auction variety, occurring within the previous day's value area. Price rotates randomly back and forth with very little confidence throughout the day. Figure 4.117. A non-conviction day occurring in June, gold, May 24th, 1989. In hindsight, a non-conviction's day's range can be misleading, for it appears as if a number of good opportunities should have been generated as the day progressed. If in the thick of such low confidence activity, however, traders are provided no real reference points by which to base their trading decision. Consequently, traders often end up forcing trades that just aren't there. Figure 4.117 provides a good example of a non-conviction day in the gold market. After an open auction, gold spent the remainder of the trading session auctioning back and forth with no apparent directional conviction. The completed profile looks like a normal variation day, but at no point was there a clear indication of other time frame presence. On such a day, it is relatively easy to lose objectivity due to the lack of market sentiment. When a non-conviction day develops, it is best to stay out of the market altogether, or any trading decision would be based on conjecture and random price rotations. Long-term non-trend markets. On a larger scale, long-term activity may at times exhibit a lack of directional conviction. While long-term traders should not have positions in the market, there may still be plenty of opportunity for day time frame traders. Figure 4.118, for example, crude oil exhibited extremely erratic behavior for several weeks, auctioning back and forth with no long-term conviction. Although this was clearly a market to be avoided by long-term traders, the resulting price spikes and gaps offered several high percentage trades for day time frame traders. News influence markets. The final stand-aside scenario is the day prior to major news announcements. Generally, many of the other time frame participants have balanced their positions prior to the scheduled news announcement. Thus, the day or two just prior to the news is often left in the hands of locals and other shorter-term traders. The resulting low-volume environment can be dangerous, for rumors and predictions can cause price to rotate wildly. Summary. Staying out of the market is more difficult than it sounds. When there are few clues regarding directional conviction, it is easy to lose objectivity. Sitting in front of a quote monitor all day without placing a trade requires a tremendous amount of patience. Even the most experienced traders begin to hear the little subjective voice, "It has got to break. TPOs favor sellers. Sell it." When the market has no confidence, stand aside until new activity develops. Not only do bad trades lead to losses, but they also keep you from entering a good trade when the opportune conditions finally arise. News. The release of major news announcements, such as gross national product, merchandise trade, or producer price index, often creates a violent knee-jerk reaction by the market's participants. Trying to anticipate the news item and how it will affect the market sentiment is a highly dangerous gamble. Once the news information is out, price moves so violently and with such speed that it's nearly impossible to make a rational trading decision or locate your trade where you want it. This is due to the manner in which the news is generally announced. The initial number usually causes a sudden price reaction depending upon early estimates that form market opinion. Soon after the actual announcement, however, there are often a revision of previous period's figures, which can cause further erratic movement. Finally, the components that make up the economic figure come out, often causing yet another reaction to the number. All of this activity takes place in an extremely short period of time. The resulting sporadic price spurts can wipe out substantial amount of capital in minutes. Long before a piece of news is ever announced, the market's participants form expectations that begin to influence market activity. A consensus opinion available in Barron's and various news sources is, in effect, built into the market prior to the news announcement. If a trader is aware of the market's perceived notions regarding the pending news, then he or she can evaluate the true strength or weakness of the market by observing the reaction to the actual numbers. Let us look at a real market example before Producer Price Index, PPI, was announced on May 12, 1989. The bond market was expecting a number between plus 0.06% and plus 0.08%. Due to the bearish expectations, bonds had been in a short-term down auction, as evidenced by 0.1 in figure 4.119. The direction of the major auction, however, was up, 0.2. The actual number released was plus 0.04%, which indicated lower inflation than expected, a bullish sign for bonds. The market immediately rallied some 16 ticks, figure 4.120. Shortly after, it was announced that an increase in oil contributed to plus 0.07% in the figure. Thus, had it not been for oil, the PPI would have actually been negative. This extremely bullish news caused bonds to rally nearly 2 full points to 90 to 26. Many market participants lost money because they had anticipated a bearish number. It is extremely difficult to trade during the volatility created by a news announcement. Traders could have gained valuable information on the 12th if they had entered the market prepared with the following information. Number 1. Direction of the major auction. 2. Known reference points. And 3. Market expectations for scheduled news announcements. The direction of the major auction was up, despite the short-term selling rotation due to bearish expectations. The market had broken below several days of overlapping value that's not in view on May 9th, establishing two important reference points on the 9th's high 89 to 16 and the point at which the market broke lower 89 to 04. As previously mentioned, the consensus opinion was that the PPI should have been between plus 0.06% and plus 0.08%. When the number was announced as bullish for bonds, the market auctioned through the first reference point, 0.1 in figure 4.120, easily and slowed at the highs for the 9th, 0.2. The subsequent announcement of the PPI's components was also bullish, and the market exploded to the upside. Despite the recent down auction, bonds had no trouble auctioning 2 points higher on May 9th. It became apparent that the underlying market conditions were strong. The following list displays the basic news/market sentiment relationships, and other previous bond example is illustrated by the third scenario denoted by an asterisk. The major auction was up, the news announcement was bullish, and the market reacted by auctioning substantially higher in the day time frame. These circumstances indicate a market that is strong and continuing higher. And so here's a little table Maybe print it out, keep it. Summary. Instead of getting emotionally or financially whipped back and forth along the market during a major news announcement, traders can use the news to their benefit by following these steps. 1. Balance your inventory so that you hold no positions going into the scheduled announcement, except for long-term traders. 2. Make note of market expectations, recent market direction, and salient reference points. Number 3. Monitor activity after the actual number is announced to determine underlying market sentiment. Use the above reference chart if necessary. Number 4. Monitor ensuing activity near recent reference points for confirmation or rejection of apparent conviction. And number 5. If the opportunity is present, enter the trade. Place stops at previous known reference points. Exit if conditions arise that contradict market sentiment. Beyond the competent trader. Let us look back to David, the aspiring pianist, and his path to becoming an expert musician. When he reached competency after years of learning and practice, he had mastered the technical and mechanical aspects of playing the piano. Yet, he had not transcended to the physical notes on paper to become an expert. Similarly, a good market understanding is only part of the equation for achieving expert results. Many traders who develop a solid academic background still do not make enough money to justify being in the market. To progress beyond the average, beyond the middle of the bell curve, and into the upper extremes of excellence, you must achieve self-understanding. To become a proficient trader, it is necessary to become so intimate with the mechanical aspects of the market that they form a holistic pattern in your mind. Only then can you begin to understand how your own personal strengths and weaknesses directly influence your trading performance. As Adam Smith said in his book, The Money Game, if you don't know who you are, the market is an expensive place to find out. We have reached the end of the competent chapter. The study of the basic theories behind evaluating market-generated information through the market profile is now complete. We have covered a tremendous amount of information in a relatively short time, so before we move on to the next step in the learning process, take some time and review and solidify the concepts we have discussed. Observe the market. Test and apply your market understanding. Build the experience that will clear the fogged corners of the window to reveal the big picture. Chapter 5. Proficient. Yeah, no problem, Andre. Throughout the book, we have followed the 5 levels of skill acquisition through a college student named David. After hearing a moving rendition of Beethoven's Moonlight Sonata, David decided he wanted to learn to play the piano. He started the learning process by studying purely derivative sources, taking lessons and reading books on music theory. After becoming familiar with the basics, David began to practice while continuing his derivative learning. In other words, the instruction and mechanical knowledge acted as a catalyst, allowing David to actively apply and develop theory into actual music ability. He was building experience. Think real quick. Finally, after years of practice, lessons, and study, David transcended the realm of derivative knowledge. He simply knew the theory and technique backward and forward. When David sat down at the piano, the fingering had been committed to muscle memory, and the notes and time signatures were so fully assimilated in his mind that he no longer actively thought of them while playing. David had reached a level of proficiency that allowed him to express his thoughts and feelings through an instrument as though it were an extension of his emotion. Becoming proficient in any endeavor is a highly personal process. Think about something you excel in, something that has been more instinctive, intuitive ability. Perhaps it is an athletic talent such as golf or tennis. Maybe you have a knack for fly fishing, sailing, or chess. Whatever it is, remember the way you felt when you finally performed the activity perfectly. Suppose that after Years of waiting on your golf swings through lessons, Arnold Palmer books, and hours at the driving range, you play the perfect round. A proficient golfer intuitively combines course conditions, wind, the ball's lie, stance, club selection, position, and the actual stroke to achieve the perfect shot. Imagine the exhilaration of having the ability to make a shot 70 times in one round. A perfect round transcends all derivative learning. It is the culmination of knowledge and experience. When all the factors come together, the golfer can feel the shot, developing on learning to recognize the feeling of excellence in the result of a synthesis of derivative and empirical knowledge of academic learning and hands-on experience. A futures trader who has progressed beyond competency also begins to intuitively feel when conditions are right for a successful trade. Again, this intuitive ability is fostered by more than just a sound fundamental base. Through market experience, you will begin to recognize certain situations where all of the concepts and theories come together and you feel the trade. Once you have reached this stage of market understanding, the difficult part becomes learning to trust your intuitions, to trust the feeling of opportunity. In other words, a proficient trader must begin to learn and develop self-understanding. In the final stages of learning, experience becomes the primary teacher. An introspection of vehicle for excellence. In this chapter, we will discuss the importance of self-understanding and its relation to becoming an expert trader. The results equation, market understanding times self-understanding plus strategy equals results. The results equation is an oversimplified formula for achieving successful trading returns. It is built upon three concepts: market understanding, self-understanding, and strategy. Up to this point, we have covered the large volume of theory that leads to a sound market understanding. In addition, we have discussed many trading strategies based on specific structural features such as opening types and special situations. We have also examined the strategic application of more general concepts such as other time frame control and trending versus bracketed markets. These structural strategies arrive from the understanding of the marketplace, but they are useless if a trader does not have the confidence to implement them. A truly effective strategy must incorporate your strengths and weaknesses into a comprehensive game plan that uses your abilities to the fullest potential. The pivotal element in turning market understanding into practical, successful trading strategy is self-understanding. You may have developed a thorough understanding of the marketplace, a reliable academic trading strategy, but without understanding yourself, you will not be able to effectively employ that strategy. Your trading results will not rise above the bell curve average, and as we have mentioned before, the average market participant does not make money. To become proficient, you must begin the ongoing process of learning to understand yourself. Self-understanding, becoming a successful trader. Most of us do a great deal of soul searching before we choose a profession, whether we realize it or not. In this process, we consider not only the intellectual and academic requirements of the profession, but also how does the vocation meet our own psychology and emotional needs. What does it take to become a surgeon, and can I deal with patients that die on my operating table? Do I want to work for someone else, or do I want to call my own shots? Do I want to manage people, or would I prefer to do research on my own? Do I want a profession that is steady and predictable, or would I prefer to have each day be entirely different? Additionally, we also consider whether or not we possess the innate skills that can spell the difference between success at one profession over another. Do I have the precision hand-eye coordination to become a professional baseball player, the mathematical mind to work as a physicist, the writing style to become a reporter, or the mechanical aptitude to become a mechanic or electrician? These basic skills are usually identifiable early on. When choosing a profession, we need to consider whether we possess the skills required to succeed at that profession. While there are many ways to develop these skills through education, coaching, and experience, the seeds must already be planted if they are to grow. Most individuals have never given much thought to the underlying skills necessary to become a successful trader. Consequently, when they begin to trade, they wander into the various dangerous area of totally unprepared. The personal characteristics that generally accompany success in the futures market include maturity and stability, a strong sense of self competitiveness as opposed to team competitiveness, the inner strength to maintain contrary opinions, an orderly mind, and the ability to make a decision and act with confidence. The ultimate decision to become a professional futures trader involves melding of your own personal skills with your financial and emotional needs. Many view futures trading as a glamorous profession in which it is possible to make a lot of money with very little effort. That's a fake cough. Few professions are truly glamorous. However, and to the most successful futures traders, the greatest reward is often emotional, while the financial reward is regarded as secondary. If this comes to a shock to you, consider our Olympic athletes. Although a few are compensated well through sponsorships, the majority of these individuals are in an athletic profession first for the emotional value, for the inner feeling of accomplishment that comes with mastering a sport, with winning the game. The financial rewards are secondary and flow naturally as a consequence of their success. And this, it seems, is where most future traders err. They are drawn to, and in the sense intoxicated by, the lure of financial reward, while never giving a second thought to the emotional or intellectual requirements of success. Most traders, like drunk drivers, should be taken off the streets. They are trading under the influence of that many advertisements that blanket the pages of trading magazines and newspapers with claims and near promises of quick, easy success. Each month, a new guru is touting a breakthrough system that turns a computer into a black box gold mine, entering the orders and scoop out your profits. These glittery ads spark interest and induce sales, but they are misleading. In contrast, how would you respond to an advertisement that read, "Wanted, people willing to undergo specialized training in how to succeed. This program will require rigorous intellectual schooling, intensive introspective geared toward identifying invisible blocks to success that are trapped within you, and then a long behavior modification process necessary to overcome these inner obstacles. At the same time, you will undergo a daily on-the-job training program. Requirements for this training program are as follows: intellectual ability, a meaningful amount of capital, and the willingness to immerse your entire self-esteem into the program. It is anticipated that you will lose most, if not all, of your capital, and you will be forced to rationalize the whole experience to maintain your self-esteem. Although it takes a minimum of 2 years to reach a moderate level of success, soon after the initiative training program, the majority of you will drop out because it is too hard, takes too much time, requires too much flexibility, and is not well defined, and there are not enough concrete rules. Of the few that remain, less than 10% of you will enjoy the feeling of exhilaration that goes with completing what you set out to accomplish. Like the artist who only gets better, your newly acquired skill and experience will be just the start of the process that you can continue for a lifetime. You will be equipped to succeed at your profession. You will be an entrepreneur. This imaginary advertisement could apply to virtually any serious professional venture. It is not meant to convince you to trade, to not it is not meant to convince you not to trade. Rather, it is meant to dispel the glamorous illusions that surround the field of futures trading. You have already experienced the difficulty of learning in the vast amount of theory that make up the market understanding. Developing self-understanding is just as difficult, perhaps more so, for self-understanding cannot be learned from a derivative source. Self-observation. The profile graphic enables a trader to objectively organize and observe the market's behavior, which leads to the development of market understanding. Similarly, self-observation is essential to developing self-understanding. One of the most effective methods to observe and reflect on your actions is to keep a trading journal. For a trading journal to be useful, you must be honest and consistent, writing down your thoughts, feelings, and surrounding circumstances before, during, and after each trade. Observing how your emotions affect the outcome of each trade can reveal your propensity for risk, your intuitive skills, the effects of outside circumstances, and a myriad of other factors that contribute to self understanding. Eventually, you'll begin to identify behavioral patterns and the types of events that directly affect your trading performance. Perhaps you are overly affected by conflicting news sources and professional opinions. Maybe you find it difficult to trade against the crowd and you are easily shaken from your convictions by a contrary opinion. For example, you may notice that every time you make a trade based on a fundamental source, you exit too early and have little confidence in the trade. If this is the case, it may be best to simply not expose yourself to outside opinion. Or perhaps you want to be a long-term trader, but find you have trouble sleeping during the nights when you are carrying outstanding positions. By keeping a trading journal, you can begin to understand how you affect your trading results. The whole brain trader. Although we still know relatively little about the vast capabilities of the human brain, research has revealed that the brain is divided into two separate hemispheres, each having very different functions. Bennett W. Godspeed describes these differences in the Tao-Jones averages. Our left hemisphere, which controls the right side of our body, is analytically oriented. It reasons logically and sequentially, and it is responsible for our speech. It is adept at math, accounting, languages, science, and writing. Like a computer, it is programmable and is nurtured by other highly analytical educational process. The properties of the left brain are not unique. Man has developed computers that can duplicate these functions. Our right brain hemisphere, which controls the movements of the left side of the body, is unique. It operates non-sequentially, is intuitive, artistic, has feelings, is result-oriented, sees the forest and not just the trees, and controls our visual perceptions. Since it's nonverbal, it communicates to us through dreams and gut reactions. The right hemisphere provides and stores all of the nonverbal experience, a vast amount of input, certainly much more than we can verbally retrieve. The difference between the right and left brain functions explains a great deal about the diversity of interest and talent in human species. Every individual has a different right-left brain balance, resulting in a vast array of mental and physical abilities. Someone who is left brain oriented might become an excellent scientist or administrator, whereas a right brain person would be more likely to become an artist or a playwright. The division of the right and left brain thinking is readily apparent in the futures market as well. The technicians who analyze historical data, economic figures, charts, and other technical information are primarily left brain oriented. Conversely, floor traders who rely on instinct are acting according to the right brain intuition or gut feelings. Unfortunately, attempting to trade with only the left or right hemispheres will result in an imbalance and poor results. The most successful traders are able to achieve a balance between analytic left brain and holistic right brain. They are whole-brained traders. The left hemisphere. The left hemisphere is highly attuned to time, rules, and facts. It has been shown that this half of the brain, while very precise, is capable of processing only small amounts of information at a time. Therefore, attempting to trade with only the left factual portion of the brain is very limiting. It incorporates only one viewpoint. Yet, there are times, such as in preparation planning for the day, when it is necessary to be very exact and calculating. To grasp the facts, you must often consider that very rational and individually. Still, the left hemisphere is seldom able to successfully coordinate the vast amounts of conflicting information disseminated by the market each day. Imagine yourself sitting in the front of your quote monitor, observing a trading day when the market seems to have gone haywire. You murmur in a barely audible voice, I cannot believe what is happening in the market today. Your left brain is whispering to you, the analytical decisions you made based on rational processed facts have not been confirmed by the market. By immersing yourself in technical indicators and scientific theory, the real evolving nature of the marketplace slipped right past you. The right hemisphere. The left brain stores knowledge, however, only through fine tuned interaction with the intuitive right hemisphere can you successfully synthesize the knowledge and develop understanding. The right hemisphere is generally known as creative, emotional half of the brain. It is dominated by free association and holistic processing of mass amounts of information. A trade based on pure emotion may have even lesser chance of success than a trade based on calmly calculated fact. Nonetheless, once the market opens, it is impossible to analyze the vast numbers of interacting elements that are combined, absorbed, and reflected upon by the market at any point in time. It takes a careful balance of academic knowledge and intuition based on a larger understanding to trade successfully. Combining the two hemispheres. It is possible to mentally change gears in order to use both hemispheres of the brain. Each has a clear advantages and powers. After the markets close, for instance, the analysis of the day's activity and preparation for the following trading sessions best accomplished by using predominantly left analytical talent. On the other hand, when the market is in full gear, the fast processing, free associating right brain should have more control. Ideally, we should strive to operate in a more central hemisphere, freely calling on both sides of the brain to contribute when needed. Neither hemisphere should be blindly followed, and to do so would be an act of a half-brained way, nor should we ignore either, for each effectively represents half of our brain. By understanding both and being able to use the correct hemisphere for the correct task, we can be more whole-brained and effective in our trading in our decision making. Recall our discussion of Bears linebacker Mike Singletary in section 1 of chapter 4. Between games, Singletary uses analytical left brain skills to design a game plan and thoroughly understand the opposing team's offense. When the game started, however, he did not have time to actively process the overwhelming amount of incoming stimuli. He then operated in the right brain dominated mode, relying on intuition and holistic pattern recognition to guide his actions. Experts in any field, like Mike Singletary, make whole brain balance appear easy. This misconception is apparent to any trader who has had a gut feeling about a trade or an opinion based on careful analysis, only to see the market move in the opposite direction. Like any worthwhile endeavor, whole brain trading takes time, patience, and experience to master. You may come to realize that you are predominantly right-brained or left-brained person. This is the first step in achieving balance. By knowing your right brain strengths and weaknesses, you can begin to develop a trading strategy that best uses your individual talents. Strategy. As we near the end of Proficient, we look at the role and importance of strategy. Throughout the book, we have discussed many trading strategies based on the market structure. However, there is a difference between complete strategy and just managing a trade. Individual trades are guided by a set of rules based on market understanding. A complete trading strategy, on the other hand, is more of a holistic game plan built upon an infrastructure of market understanding, self-understanding, and structural guidelines. Every trader has a different time frame, different goals, and different needs and emotions. Consequently, developing a strategy is unique, individual process in which we mold our strategy to best use our strength and support our weaknesses. In this discussion, then, we focus on the business aspects of strategy, purposely avoiding the more personal elements of self-understanding. There are so many facets to running a business. You must first consider the tangibles, such as capital, risk, cash flow, taxes, and other general expenses. Then there is the upkeep and use of informational sources, basic record keeping, and performance evaluation measurement. Of equal importance are the intangibles such as knowing your competition and the role of time, both in managing your own time and introducing a new product. Also, with the category are qualities like dedication, daily execution, and overall strategic planning that are ultimately the driving force behind any successful business. Trading is a business. It involves the same tangible and intangible elements of any business strategy. We will examine many of these crucial areas, first from the general business perspective, and then within the context of how together they form a strategic trading plan. Capital. When running a business, two golden rules apply to capital. 1. Make sure that you are adequately capitalized to begin with, and 2. Conserve it. A business that is undercapitalized is handicapped from the start. A new venture must be able to absorb unexpected startup costs as well as fund projects that may be important to long-term survival. There are obvious costs of trading, particularly when one is just starting out. It is crucial that traders are adequately capitalized for their style of trading. For example, day traders generally do not need to be as highly capitalized as long-term traders who hold positions overnight. However, even a day trader needs enough capital to take advantage of the market created opportunity to take a trade home with minimal risk, such as that which is often provided by a 3 to I day. Undercapitalization leads to tick watching. Traders who must constantly worry about taking a loss are less likely to be objective in their interpretation of the market and therefore how they manage their positions. Location. Locating a business is similar to locating a trade. Where would you prefer to build a gas station? On a four-way corner just off the interstate, or somewhere between two traffic lights on a road divided by median strips? Trades, too, are located based on cost revenue considerations. Where would you prefer to buy for a long-term trade? Near the long-term lows with strong apparent excess to lean on, or somewhere in the middle of a long-term range? A poorly located trade suggests that you are assuming greater risk or less optimal reward. How do you achieve optimal trade location? Planning. Do your homework. Identify regions of potential good trade location afforded by excess, balance areas, and brackets, and then put your orders in ahead of time. When you are in the thick of the trading day, the best trade location often looks like the worst at the moment it is reached. Remember, the best trades generally fly in the face of the most recent activity. It becomes extremely difficult to pull the trigger to make the trade. A little subjective voice begins to cloud your rational decision making ability to the point that you sit there frozen, watching a good opportunity slip away. Many times, ideal trade location seems too far away from the market to move in one day. Put the order in anyway. The anxiety that often accompanies such dynamic moves can keep you from entering the trade unless the order is already in the pit. In addition, if the trade location is truly ideal, then those prices will not be offered long enough to enter the position unless you have already placed your order. Just as the good chess player always plays several moves ahead of his opponent, playing ahead of the market is what secures good trade location. Timing. Negotiating skills are an important part of business, and patience is crucial to a successful negotiation. For example, now and then every business has to deal with its suppliers. Would you rather negotiate when the product is plentiful or scarce? Timing of your negotiations often have direct impact on the price you will pay. Timing a trade is just as important as timing in a negotiation. Like the business that waits until its supplier has excess, traders should patiently wait for the markets to demonstrate excess before they act. Many traders have strong bearish opinions prior to the stock market crash in October 1987. However, those who sold too early were forced out of the market for financial reasons long before the global selling began. Traders who are consistently too early need to be more patient in their negotiations with the market. Information. Every business decision and every trading decision is based on facts gleaned from market information. The car dealer only restocks his inventory if his information sources suggest that he will be able to sell the new cars. His information tells him the size of the market, the willingness of the consumer to buy, how many cars he should purchase from the manufacturer, and what he should charge for his stock. The same decisions must be made in any market. Information influences virtually every aspect of a business strategy. In a sense, your information sources are your eyes in the market. This is why it is essential to trade based on reliable, objective information. Many traders surround themselves with so many opinionated and conflicting sources that their decision-making abilities are paralyzed. Think back to Jim Kelvin, the currency trader introduced at the beginning of the book. He knew that the yen was weak, based on purely objective market-generated information. Unfortunately, he also considered several other conflicting technical and fundamental sources that made him doubt his intuitive ability. If conflicting sources are hindering your trade, eliminate them. Good business persons will narrow their information down, select the most reliable sources, and get rid of the rest. Streamlining your information helps you arrive at decisions faster and earlier. 1 second, school's calling me. Know your competition. Perceptive businesses understand their competition and the kinds of responses to expect from them and devise their strategy accordingly. What will the other players do if price drops too low or rises too high? General Motors has a pretty good idea of what the Japanese car makers will do given any number of price-related decisions. Such knowledge of participant behavior is applicable to trading as well. Successful traders have a good inclination of how other market participants will react to a given change in price. From a trading standpoint, one part of knowing your competition should involve making a continual assessment of whether the other market participants, your competition, are too long or too short. For example, if the market that has been in a sustained up auction suddenly breaks in the day time frame and stalls, creating a B formation, participants were probably too long. Though, in understanding of the competition, you will know that the activity was most likely a long liquidation break and the buying auction will continue. Every successful business person and every successful trader understands the behavior of the other participants. Know yourself. In addition to knowing your competition, you must know yourself. What is it you do best? Under what conditions do you find it difficult to be objective? There are many examples of business that have grown very successful by identifying and concentrating on their specific strength, such as Midas mufflers and McDonald's hamburgers. Learning to recognize, accept, and work with your strengths and weaknesses is perhaps the most difficult aspect of becoming an expert trader. Earlier, in Proficient, we discussed the U portion of trading at length. However, a derivative source can only offer suggestions and provide ideas for self-growth. Self-understanding must be developed through continual self-observation and introspection. Keep a trading journal, find patterns of thought and circumstance that lead to successful trades, and actively incorporate those patterns into your trading strategy. Eliminate negative influences that cause bad trades and promote irrational thought. Self understanding is an ongoing process essential to an effective overall strategy. Consistent daily execution. A healthy business turns out revenues day after day. The old adage, successful trading is a lot of small losses and a few big winners, is simply not true. It still may be that the really big profits are made on a few trades, but the first goal is to see that the overhead is covered on a daily basis. A lot of small losses actually contribute to the overhead. A proficient trader will generate revenues virtually every day. Consistency breeds objectivity. Consistency produces cash flow and takes care of current expenses such as in-trading office space, quote equipment, medical insurance, and so on. Consistency also eases tensions so that the business can operate from a clear state of mind, look ahead, and plan expansion. Inventory. Both in general business and trading, inventory management often spells the difference between success and failure. The goal, of course, is to buy at the most advantageous price. And like investing in real estate, that generally means that you have to buy inventory when no one else wants it, or else you do not get the ideal price. Similarly, a trader will seek to initiate larger positions when the market appears to be near its long-term highs or lows. Price generally reaches a long-term high when the entire market is buying, and therefore when it is least popular to sell. Conversely, price reaches a long-term low when the entire market is selling and is at least popular to buy. Keep in mind, however, that many traders lose a lot of money attempting to pick market tops and bottoms. Be alert to conditions that create market extremes and place your positions just after the high or low has been confirmed. The handling of inventories varies from business to business, just as traders handle their positions differently. For example, locals handle their inventory much like football ticket scalpers outside the stadium or the grocer in your local supermarket. High volume, low markup. The less time spent on the shelves, the better. Long-term traders, however, probably handle their positions with greater patience, much like a jeweler and his diamonds. There are no costs associated with not having enough inventory, as well as costs of having too much. If you have no inventory, no positions, your opportunity for revenue declines. On the other hand, if you carry too much inventory, you may not have enough capital or space to take advantage of new opportunities. In addition, as one's inventory grows older, it may lose or gain value depending upon changing market conditions. The overriding difference between most businesses and trading, however, is that the futures market controls the price of your inventory. You have less control over risk and opportunity, and therefore must pay much closer attention to your inventory in changing market conditions. Risk. Every good business person keeps a watchful eye on risk. This means dedicating the majority of one's time and capital to playing the short odds rather than the long odds, for the main objective is to stay in business. This concept is well illustrated by a theme common among sales organizations. Generally, the salesperson who continually seek the big deals hoping to hit the grand payoff invariably go broke. On the other hand, the individuals who succeed are those who work 5 or 6 big deals while spending the majority of their time on the 70 or 80 small accounts that provide consistent revenue. If a decision is made to go after a big deal, it is generally only with a portion of the capital or resources of the business. An example of how one might incorporate this concept into one's trading strategy, consider the regulation of maximum trades, large long-term positions. Suppose the part of your trading strategy is to trade up to 3 futures at one time. If so, then perhaps you limit yourself to just one maximum trade at a time. This way, you do not risk all your trading capital on big deals. This is just an example, not a specific recommendation. Similarly, if your capitalization is lower, or if you want to reduce the anxiety that often accompanies maximum trades, perhaps you elect to participate a maximum trade using option spreads. Trading requires continual risk evaluation, like a credit policy at a bank where overnight, intermediate, and long term spending limits are calculated precisely through conscious decisions. With each new trade, one must evaluate the accompanying risk. There are short term goals as well as long term goals. Good business people realize that long term goals are achieved as a result of the constant cumulative meeting of short term goals. Write down your goals. Make them clear and concise and strive to achieve them through a realistic shorter term checkpoints. From time to time, review them and make sure they are still represent your current wants and needs. Record keeping and performance. All businesses keep records for reasons more than satisfying the IRS. Records help a business remain objective and realistic when evaluating performance. How productive is your sales force? How well is the market responding to your advertising and marketing? Is your overall strategy producing the hope for results? What is the bottom line? Record keeping is equally important to trading. Records give you an objective way to evaluate how your trading strategy is faring and whether it is in need of change. Proper record management should tell you more than if you are making money. It should reveal where your trading revenues and are coming from. Proper record management should tell you more than if you are making money. It should reveal where your trading revenues are coming from, what market conditions and trading techniques are most profitable, whether you are meeting your daily expenses, and so on. The better your records, the easier it is to isolate the problem areas, find solutions, and hone in on what you do best. Dedication. Dedication is one of the intangibles. Unique to each individual and therefore not easily measured or valued, dedication is doing your homework every day. It is keeping up your charts, getting up that extra hour early to get a head start on the markets, and putting in an extra hour afterward. Dedication is not just time and work, it is the heartbeat of a business. It is the personal element, the desire for personal achievement possessed by a handful of individuals. It is the driving force behind any successful business. Just wanting to be successful is not enough. You have to make it happen. True dedication involves paying a price, and there is a price. Applications. When dealing in the minute-to-minute or day-to-day specifics of trading, it is sometimes difficult to appreciate the importance of strategy. Most traders have spent thousands of dollars learning the market and developing rules and guidelines for their trading. These aids come in multiple forms, from the market profile to rigidly disciplined trading models. Unfortunately, much of the knowledge and money is wasted unless it is also woven together with a comprehensive strategy that takes into the account those attributes that are important to staying in business as a trader. In summary, we offer 3 very general steps to getting started in developing your trading business. Step 1. Accept and begin to view trading as a business. Step 2. Develop a comprehensive strategy based on the concepts of successful business management. To reinstate, every business and trading is no exception. Needs a healthy interaction of the following areas if it is to survive: capital, timing, location, knowing your competition, knowing yourself, consistency, information, inventory, risk, goals, record keeping and performance, and dedication. This is very ideal listing collectively considered forms from the strategic shell of trading survival. Step 3. Formulate specific rules and mini strategies that help guide and mold your individual trades in order to meet long-term goals of your trading strategy. Unfortunately, we as humans cannot function purely on a strategic level. We have to deal with the facts, disappointments, and our own shortcomings, capital requirements, the day-to-day details of physically and mentally entering and exiting trades, and so forth. Thus, once these long-term goals have been laid out, we can begin to outline a series of short-term goals and trading disciplines to help us fulfill our long-term strategy. Figure 5.1, Trading Strategy Flowchart. You guys can go back to that. What other book, Adam? I'm not sure what other book. Figure 5.1 illustrates, in a very general sense, how one trader might design the underpinnings of a business trading strategy. This figure represents a basic set of guidelines that begin to tie the strategy together. Once the basic requirements are established, one must then fine-tune them with yet additional rules so that eventually a daily trade-by-trade application can be reached. Summary. The poor performance of most professional Wall Street investors is the result of an imbalance, a lack of whole-brainedness. Bennett W. Godspeed, The Dow Jones Averages. Most traders eventually become competent, but few transcend the rules and theories to reach proficiency. To progress beyond the average, traders must learn to understand themselves, how their personal strengths, weaknesses, and individual personalities affect their trading results. On the other hand, some traders have a good self-understanding but view their trading as a part-time endeavor or a hobby. Trading is a business, and to become proficient, a trader must develop a business strategy. Successful futures trading is the result of a delicate balance between derivative learning and experience, between analytical thinking and intuition. A proficient trader forms a trading strategy built upon an infrastructure of market understanding, self-understanding, and structural guidelines. He or she begins to intuitively feel when conditions are right for a successful trade. Balancing left brain discipline with right brain creativity, strive to achieve balance to become a whole brain trader. We're going to keep powering on, guys. The expert trader. The knowledge that is gained from the books and experience is an integral part of becoming a successful trader. But the path to expert trading begins within yourself. This is my favorite chapter. You must believe that you can reach your goals, fulfill your aspirations. Mastering the academics is not enough. An athlete with average ability will be victorious over opponents of greater skill if he believes he can be a champion. Achieving the level of expert in any pursuit is a challenge that few people attempt, for it requires complete dedication and determination. To reach and maintain excellence, an individual must have a desire to succeed that transcends personal sacrifice. Understandably, most people are not willing to give up the diversity of their lives for a single all-encompassing goal. Consider anyone that you perceive to be an expert in his or her field. Olympic swimmers spend 4 to 6 hours in the water every day. Great composers and musicians have been known to practice for most of their waking hours. Top salespersons work 12 to 16-hour days. The best creative advertising personnel are always rethinking their accounts, shaping and detailing new ideas. Any highly successful business exceeds the norm by going beyond the rules and calculative rationality to the higher grounds of innovation and excellence. Do you have what it takes to become an expert trader? We have covered a tremendous wealth of material from the market's smallest unit to the importance of self-understanding, but the knowledge contained in this book is only the beginning. A derivative source can impart all of the learning in the world, but again, much learning does not teach understanding. Benjamin Hoff put it wonderfully, simply in the Tao of Pooh: knowledge and experience do not necessarily speak the same language. There is more to knowing than just being correct. In your pursuit of excellence, you may sometimes stumble and feel the frustration of your mistakes. The challenge before you is not without difficulties, but with the inner strength that grows from believing in your potential, you can strive to soar beyond the averages. Feel the exhilaration that goes with completing what you set out to accomplish. As you continue to learn and build experience, remember that your newly acquired skill and understanding is just the start of a process that will continue for a lifetime. Very short chapter, but it is my favorite. Chapter number 7, Experience. One of the most astute Amazon.com reviews for this book was not intended as a compliment. The reviewer said Mind Over Markets was too complicated. Those two words capture the reason why most traders fail, as well as the reason why the book in your hands is still relevant, challenging, and insightful after 2 decades. It was written for serious traders and doesn't purport to be a total solution. Mind Over Markets is a practical handbook for developing an understanding of market behavior that will help you trade with the odds in your favor. And in the 22 years since it was published and translated into Chinese and French, the authors have continued their journeys delving deeper into practical experience. And so it is experience that this final, fresh chapter is all about. We'll bring the book learning in the preceding chapters into the light of real experience, where real money is won and lost in the market's endless heaving to and fro. The examples we'll employ are simply meant to provide context for the content. The synthesis of the 5 stages of learning can only happen in practice. Set aside your expectation. Traders, being human, want markets to be orderly and easily understandable. But if you start with that expectation, then you're off on the wrong foot. We're all prone to seeking only what we're looking for, which keeps us from being present for what is actually happening. Being free from all distractions, he can undertake his practice wholeheartedly. Practice combined with non-attachment helps him to continue his search until he reaches the goal. To be successful, you must set aside your desires and expectations. You've got to get inside the head of the people that you're competing against. How gruesome does it feel to get caught short? How would the feeling manifest itself in a herd of day traders? So much of trading today is about momentum, which can offer invaluable insight when considered in the proper context. After you understand how markets operate, not as orderly and scientific as you'd like, then you've got to figure out how your own head operates. You can have all the market knowledge in the world, but if you don't understand the ways in which rationalization can be a powerful gravitational force, then the market knowledge might not help you. Trading is a game, and if you can figure out what's going on in your head and what's in the head of your competitors, you'll most likely win, or you're more likely to win. Mind Over Markets in Profile. In 2007, 15 years following the publication of our original work, we published Markets in Profile, Profiting from the Auction Process, which examines the market's continuous two-way auction process by taking a profoundly different approach towards sorting and understanding the differences in behavior between the various time frames: day, short term, intermediate term, and long term. This is the book that we'll read next. Seemingly knowledgeable experts routinely maintain that there is a buyer for every seller and seller for every buyer. This simple utterance sets up a mental block that impedes a real understanding of the auction process. Actionability, reality. How do you say that? Actionability, reality begins with understanding the relationships and behavioral expectations among the time frames. While it is true that there is a buyer for every seller, the buyers and sellers are not evenly matched. They are operating in different time frames, which means their actions have different weight. It is an imbalance between the time frames that drives the auction process. The longest time frame, for example, most commonly transacts with the day or short-term time frames that are considered to be weaker hands and less committed to holding inventory. When this occurs, the inventory for shorter time frame often gets out of balance, which leads to short covering rallies or long liquidation breaks. This is the ebb and flow of the market's tides. Markets in Profile offers a deeper dive into the behavior of each of the separate time frames. The book revolves around the central idea: information has no impact until individuals act on that information. There are many responses to any given piece of information. I'm going to move this up so I can stand up and read this. My back's starting to hurt. Information has no impact until individuals act on that information. There are as many responses to any given piece of information as there are humans who receive it. We all find ourselves somewhere on the long continuum between leader and follower in every endeavor. To illustrate the importance of this concept, consider what would happen if you were simultaneously share a perfect investment idea with 5 different people. One of those 5 might act immediately without requiring further evidence, while each of the remaining 4 would act successively later time periods, waiting to see proof that the idea was, in fact, generating profits. The diffusion model made popular by Malcolm Gladwell in The Tipping Point, How Little Things Can Make a Big Difference, would label each of the individuals in succession as innovators, early adopters, early majority, late majority, and laggards. These 5 archetypes can help us better understand the way various time frames interactions influence the market's auction process. Once laggards have been transcended, for example, the market is generally prepared to begin to auction in the opposite direction. If the market had been rising, the top of the rally may be drawing in new laggard longs as well as laggard shorts that are finally covering. Market understanding and self-understanding. Many successful traders we've worked with over the years have expressed a common opinion. Once they've gained a market understanding, at least 75% of their results are based upon self-understanding. But attempting to advance your self-understanding is difficult. In this context, until you have a solid grasp on market fundamentals, if you're not looking at the correct information to begin with, then market understanding may never arrive. Our goal has been to provide you with the realistic framework for understanding how markets function. The essential component of that framework is the continuous two-way auction process captured and recorded with the market profile. Perfect practice makes perfect. Reading Markets and Profile, the follow-up to Mind Over Markets, is the next step on the path to becoming an expert trader. In it, you will learn to formulate a contextual understanding of the market. Real learning always begins with appreciating the importance of context. At the highest level of skill acquisition, time spent studying, interpreting, and trading the market is the most important factor that separates winners from losers, like in any endeavor. But note, the efficacy of the practice is entirely dependent on the practice being correct. You can practice a bad golf swing all day, but that dimpled white ball will never obey you until you practice a correct swing all day. The more advanced your trading, the more nuanced your education becomes. Blinded by price. You will recall that price is simply a mechanism for advertising opportunity, with time regulating all opportunities and volume serving to validate the success or failure of advertised opportunities. Most traders, as well as most academics, begin by incorporating lost my spot. Most traders, as well as most academics, begin by incorrectly responding to a single dimension of price. What is far more important is what lies beyond the response to the price. You must continually ask yourself the right question. For example, what time frame responded to price? How strong was the response as represented by volume? Were the responders innovators, early adopters, early or late majority, or laggards? Were the innovators responding opportunistically to the actions of the late majority and laggards? The Invisible Gorilla by Christopher something and Daniel Simmons. The audience is invited to view a film that features two teams passing a basketball back and forth in a complicated pattern. One team is dressed in white shirts, while the other is wearing black. The audience is asked to count the passes made by the white shirted team while ignoring the black shirted team. Here's the amazing part. Halfway through the film, a woman wearing a gorilla costume appears, ambles onto the court, thumps her chest, and then walks off the court. The gorilla is in view for 9 full seconds, but approximately half of all the viewers didn't even notice the gorilla. And not only did half of the audience miss the gorilla, but they couldn't believe a gorilla was really there. Traders who are focused solely on price miss most of the salient information embedded with the market's two-way auctions. These same traders often wonder, after the market has closed, how they could have missed some of the market's most obvious opportunities. Many resolve to step back and take a more comprehensive view of the market, focusing on those elements that are far more important than price. The difficulty is that leaning on price has become such an automatic response that it is difficult to broaden your focus and execute new resolve. But there's a course of action that will help you overcome that automatic knee-jerk response to price. Preparation. Be prepared. How do you prepare to overcome the inexorable forces of will, memory, and desire? You start by developing a tactical plan, a game plan that lays out tactical choices based on potential outcomes. The execution of the tactical plan, of course, requires that you remain very much aware of the current price action. But the goal is to be prepared to make a tactical choice, avoiding price blindedness. My personal preparation begins by getting as far away from the daily price as possible. I begin by reviewing the monthly bar chart, like the one in figure 7.1. Perspective. The monthly bar shows that the S&P indices are just below a multi-year high set in September 2012. Additionally, an excess low was established in November. The two most important concepts we deal with are excess and balance. Excess marks the end of one auction and the beginning of a new auction. When the market comes out of balance, it also represents the beginning of a new auction. Notice that the excess on the September high is far less than the excess on the November low. The long-term trend remains up. Next, I review the weekly bar. If change is to occur, it will manifest itself through the weekly bar prior to becoming evident through the monthly bar. Then I review the daily bar. Similarly, the daily bar will indicate change prior to the weekly bar. Bar charts are employed to speed read the market. Finally, I review the profiles for greater detail. Let's take a closer look at figure 7.2. The weekly bar shows an excess low followed by 4 weeks of one time framing higher. One time framing higher occurs when the low of the next week does not exceed or take out the low of the preceding week. The latest weekly settlement is close to the low for the week. Close your eyes and imagine what a weekly bar will look like if, during the early part of next week, the prior week's low is taken out. The market will have stopped one time framing higher, and an excess high will be confirmed. The cessation of one time framing mode represents change. and trading is all about understanding and anticipating change. Now imagine what a weekly bar might look like if the one time framing mode remains in place, figure 7.3. If you haven't imagined the two scenarios described above, early price movement during the following week will be more difficult to keep in perspective. Additionally, focusing on importance of weekly one time framing will reduce the odds of price blindedness. The daily bar shows excess high, similar to the excess high shown on the weekly bar. Next, focus on the downward one time framing mode. This contrasts with the upward one time framing mode under the weekly bar. Change is very likely to occur early in the week. Trading is about dealing with change. People generally don't like change, but change is at the heart of opportunity in any endeavor. The upward one time framing mode shows on the weekly bar versus the downward one time framing mode displayed on the daily bar presents an ambiguous picture. And as much as people tend to dislike change, they ABHOR ambiguity. But again, real trading opportunities develop from ambiguous situations. If the situation weren't ambiguous, everyone would be sharing the same position. The daily profile from December 14th, 2012 depicts an almost perfectly balanced day. The point of control is just a single tick above the center of the range, figure 7.4. Think of the POC as the fairest price at which business is conducted in the day time frame. This conceptual approach makes it easier to understand what is actually occurring in the market. In this case, the question in this, are traders selling S&P futures at prices below the fairest price and becoming short in the whole? Or are they playing futures above the fairest price, or are they buying futures above the fairest price? As I finish my analysis for the following week, my expectation is for a balanced Monday opening. Any meaningful change to the weekly bar will occur outside of Friday's daily balanced range. Reflect back on the weekly bar, which settled at a level where the market could continue to one time frame higher. This would represent the status quo, or cease one time framing higher, which would represent change. There are three likely scenarios when trading a balanced market. 1. Remain within balance. 2. Look above or below the balance and fail to show continuation. We refer to this as a breakout failure. When the breakout fails in one direction, it is common to see the market trade toward the opposite extreme of the identified balanced range. 3. Look above or below the balance and accelerate, which implies the breakout. Those are what we refer to as go with opportunities. Your mental flexibility and will be exponentially increased if you are always prepared for at least these three possible scenarios. The auction may be a result of an unexpected short covering rally or long liquidation break, an exogenous event, out of range earnings or economic announcement, or larger time frames entering the market. If you have already considered different scenarios, you'll be better prepared to quickly adapt to any directional auction. Overnight inventory. The final preparatory step, which is completed just prior to the pit session's opening, is to evaluate overnight trading and inventory. This is why we split out our profiles between pit sessions and overnight trade. You will only gain confidence in employing this analysis through your own observation. Misunderstanding overnight inventory or disregarding it is another example of price blindedness. Determining if overnight inventory is long or short is simply mechanical. We measure overnight inventory from the prior pit session close or settle And if the majority of the overnight trade is above this level, we consider overnight inventory to be long. Similarly, if the majority of the overnight trade occurs below the pit session settle, we deem overnight inventory as short. If overnight inventory trade occurs about equally on both sides of the prior pit session settle, then we determine that the overnight inventory is neutral. The following example, selected to explain the concept, is not all that usual. The volume that occurs overnight is often no more than 25% of the volume experienced during the pit session hours. Generally, overnight trade involves shorter time frame, weaker hands traders. If inventory gets too long or too short, the odds are good that there will be inventory adjustment shortly after the pit session opening. On occasion, the inventory adjustment can occur later in the session, depending upon the confidence level in the current pit session. The opening on December 3rd, 2012, occurring near the high of the overnight trade and begins to sell off immediately. Long overnight inventory is immediately liquidated to bring the market back into balance. Understanding the behavior of shorter time frame traders and their tendency to fall prey to price blindness is pivotal in appreciating the influence of overnight trade. Clearly, it isn't as simple as conveyed in this example. However, your final morning analysis should assess overnight inventory and alert you to potential adjustment of that overnight inventory. If overnight inventory is long, for example, and the market doesn't adjust, this is an indication of a strong market, at least in the short term. Quite often, you'll see an early adjustment when there is a significant degree of long or short inventory overnight. Not being aware of potential adjustment or seeing the adjustment as more than it actually is can mislead you for the entire session. This is a difficult concept for inexperienced traders to grasp. The best way to begin to internalize overnight trading is to monitor each day, always forming your own opinion. As we've said 100 times, self-confidence and market understanding can only be gained through your own experience. The concepts addressed here are meant to provide contextual awareness, which is the ultimate starting point for self-development. Traders who don't prepare, or who don't know how to prepare, are generally at a serious disadvantage. Being prepared includes writing down at least 3 possible market scenarios. What will I do if the auction moves up, down, or remains in balance? How will I assess the conviction of these moves? Gaps can be gold. Leading to the November 23rd, 2012, the financial news stations interviewed a number of traders and analysts who were bullish on gold based on price. Price had been rising. Let's look at the daily bar on figure 7.6. Earlier, we stated that the 2 most important concepts we deal with are excess and balance. Please note that a gap is a form of excess. View a gap as a series of invisible single prints. Lost my spot. The November 23rd, 2012 high at 1754.7 did not fill the gap, extended up to 1761.3. Long-term sellers remained in control. Once again, the importance of understanding time frames and their attendant behaviors is vital. As short-term traders were covering shorts, short-term momentum traders began to pile onto the auction. Selling to these buy orders were long-term. Short-term traders were covering shorts. Short-term momentum traders began to pile on to the auction. Selling to these buy orders were long-term, opportunistic traders who were selling at the top of a trading range, which was defined by a very visual gap. As you can see from this example, there was a seller for every buyer. However, the different time frame participation reveals that the process cannot be explained so simplistically. An inside day, an inside day followed and failed attempt to fill the gap. An inside day is one form of balance. Within a couple of days, or two most important references, excess and balance, not price, have garnered our full attention. Earlier, we outlined three scenarios for preparing to trade balance. Go with the downside breakout from the inside day. The above analysis was all published before the fact through a service offered at J. Dalton Trading. Traders who were simply following rising prices and listening to price based on analysis were likely caught long as the market began to break. Additionally, these price following traders were more likely to be buying breaks rather than selling rallies. Gaining an edge. You constantly read and hear about the importance of traders getting an edge. We have already discussed the importance of preparation, which builds upon the initial base for obtaining the advantage over those who are less prepared. Here will we discuss two additional ways for gaining an edge: learning to read and interpret market structure, and becoming an odds-based trader. In figure 7.7, you see December 14th, 2012, representing by a one-dimensional 30-minute bar chart on the left and a two-dimensional market profile on the right. The 30-minute bar chart lacks dimension and structure. It does not graphically depict the crucial fact that all prices are not equal. The market profile shows the same open, high, low, and close, in addition to showing time and volume performance at each price. The wider a single price, reading from right to left, the more time was spent at that price. Additionally, by applying the price times time equals volume equation, we can estimate volume at each price level. While we are not technically profile traders, we employ a range of tools and interwoven analysis. We value the market profile for its ability to reveal the inherent inequality in different prices, information you can leverage to trade more competitively. The multidimensional profile gives structure to the market's continuous two-way auction process. Learning to read and interpret the structure can provide you with a serious edge because it helps you avoid the perils of price blindedness. The study and interpretation of structure is a lifelong endeavor, as no 2 days are ever the same, this is an exciting and welcome challenge for many professional traders. The fairest price revealed. The example above depicts a structure that indicates a market that has gotten very short in the day time frame. The POC, or fairest price at which business is being conducted, is the longest line reading from left to right. Selling that takes place below the fairest price is an indication of traders' willingness to sell futures below the current day's fairest price. Traders refer to this as selling short in the hole, or selling short at poor prices. There isn't always a short covering rally following this pattern. However, the odds of profiting from remaining shorts have decreased, and the odds of a rally to adjust short-term inventory have increased. The above example is from Friday, December 14th, 2012, and was written about Saturday, December 15th. The capture shows in figure 7.8 was taken on Monday morning, December 17th, 33 minutes after the opening, and shows the early rally. You can never prove it was short covering rally, but from our experience, we're comfortable identifying it as such. Thinking in terms of odds will help keep you from becoming too focused on price, which will help keep you out of bad trades. You may not have wanted to go home long on December 14th close, but your taking home a short was against the odds. Market structure, not price, contain the information necessary to read Friday's market. Prior to the second edition of Mind Over Markets, we talked a lot about the POC. But since the acronym has evolved in which more conceptual descriptor, fairest price, the fairest price at which business is being conducted. The last example revealed the fairest price lens was employed to identify a particular market condition and opportunity. This was just one example of the power of the profile and how it reveals the continuous two-way auction process in an evolving visual schema. Thinking statistically, few of us naturally think logically all the time. Most of us are ruled by cascading waves of emotion influenced by our environment and the day's events. Statistical thinking is hard because it requires focus and parallel processing or thinking about several things at once. Some examples of this type of contextual thinking include simultaneously assessing current market direction, volume, and market structure. Profile shape, daily sentiment, who's buying or selling, and overall trade location within the daily, weekly, and monthly bars. That's a lot to keep straight and uncluttered in your brain. Traders are prone to overestimating how much they understand about the market by looking at price and becoming overconfident by the illusion of certainty. As Nassim Nicholas Taleb writes in The Black Swan, a book that I've told you guys about and you should definitely read, we tend to learn the precise, not the general. Nonlinear auctions occur when the illusion of certainty is shattered, and when opinions are revealed to be illusionary, human behavior can become extremely erratic. Non-linear auctions often make some traders a lot of money while destroying the majority of those who have difficulty accepting what is actually happening in the market. The trader's dilemma. In our last example, price was going lower. However, the odds of the downside continuation were decreasing. The market regulated through time. If you don't use the opportunity to adjust your position and time runs out, the financial consequences can be severe. Many traders are like new aggressive male drivers in that they know the dangers but believe it could never happen to them. Understanding the odds adds a dimension to your thought process and not only alerts you to asymmetric opportunities, but also keeps you from becoming too focused on price and ending up on the wrong side of the trade. The best example of the trader's dilemma was captured on a film over a 2-day period in early October 2021 at DePaul University in Chicago. We were presenting and filming Jay Dalton's Trading Live Market Seminar, which there's another one going on this year down in Texas. At least that's what Jim was saying. They're going to do a live in-person intensive this year if they have enough interest. It's going to cost like $5,000, but it'll definitely be worth it. The S&P indices have been declining for several days on poor volume and structure. Volume should have always been evaluated on relative rather than absolute basis. A sound structural review begins with understanding that attempted direction on each day. Elongated structure that develops in an attempted direction is viewed as a positive for directional continuation. Truncated structure that develops in the direction of the auction is considered negative for continuation. As the final day's session began, Jim stated that this may be one of those days that sees the market open weak but close strong. The odds appeared to be building against the shorts. Most traders simply continued to press the current trend, and they were addicted to price movement. We have often referred to this trader dilemma as being mesmerized by price. During the session, traders sold each small rally, which was continually adding to the short inventory. With about an hour to go, Jim asked who was still short. A few nods indicated that some seminar participants still after, with less than an hour remaining in the New York pit session, the market rallied 400 points. Jesus. The dilemma occurs when traders are compelled to act immediately upon the information that indicates a struggling decline in this example. Often this information has to be carried forward until there is a completion to the current auction. And completion generally occurs after the laggard longs have completed their liquidation, along with the laggard shorts who continue to sell. When do you cover your shorts and when do you go long? You want to cover your shorts when the odds are becoming overwhelming. Even though the auction may not be complete, you may elect to be a little late in going long. The additional information you gain by being late may lower the risk of being wrong in a big way. Failure to exercise control and patience will likely result in you getting whipsawed. The most important admission from the first printing in 1990. In the first printing of this book, we talked about buying and selling tails in profile structure. One second, guys. Tails represent short-term excess, while a lack of a buying or selling tail represents an auction high or low that has not been completed. We describe a lack of buying or selling tail as a poor low or a poor high. While the concept of tails, or lack thereof, remains true, we have since developed a more nuanced appreciation for what causes poor lows and highs. The lack of a tail may indicate that the market has gotten too long when there is no selling tail, or too short when there is no buying tail. To understand, this understanding, like all understanding, evolved over time. It is the context that leads to the high or low that signals a deeper layer of meaning. Volume will often be below the relative volume for the past several days. Tempo or pace will be halting or slow, and the profile will likely be more truncated. Once the inventory is adjusted, the market often returns to take out the initial high or low in order to complete the original auction. But this action doesn't always occur on the same day. One of the most damaging trader tendencies is acting too soon. The biggest disappointment is that there is no absolute answers. Continual practice and observation are required before this information becomes internalized and can be appreciated and fully understood. Emotional markets. In a prior example, we reviewed the situation when a market gets too short over time. The mere formation would indicate the inverse, the potential for a market that has gotten too long. A contextual understanding will likely include the inventory imbalance building over multiple sessions with deteriorating volume and market structure. A profile becoming less elongated. In the following example, we will see a profile that quickly gets too elongated, usually within a single session. Figure 7.9. On December 13th, 2012, the S&P indices broke hard and fast. As the market began to break, multiple short-term time frame traders continued to pile onto the short side of the market. There was little thinking going on. Traders have often heard us say, traders do what works until it doesn't work anymore. Price-based traders continued to pressure the market on the following day. The trade to sell every rally was still working. However, inventory was becoming extremely short. As we discussed earlier in the book, an elongated market profile is a sign of auction continuation. When the profile is too elongated, however, the result, as shown above, is often just the opposite. This kind of information can't be internalized or even fully understood by reading a book. The process of internalization begins with knowing what to look for. In the above example, a day and a half prior to the recovery rally, it was possible to begin to visualize the recovery and consider that even while the market was auctioning lower, the potential for a short covering rally was increasing. A landscape view of the market. It is highly unlikely that simple systems will win over any reasonable length of time. That's why serious professional traders begin with the landscape view of the markets. Landscape referring to a bank of monitors lit up to display potentially interconnected markets. While a trader may be trading a single market, he or she should be acutely aware that other markets could impact that single market. Examples include: in some market environments, rising bond prices may influence stocks negatively. In other situations, higher bond prices might be seen as positive for equities. 2. Depending upon the circumstance, a rising dollar has the potential to be positive or negative for stocks. Number 3. Crude oil is influenced by its own fundamentals, the dollar and the economy. With the accumulated experience, you will learn to keep a constant eye on multiple markets, paying particular attention to sudden shifts in sentiment. Personal evolution. There is nothing quite so compelling as the real personal anecdote. As the lead author of this book and full-time trader, I, Jim Dalton, would like to share a summary of my own experience with the market profile. Hopefully this passage will provide some insight and inspiration as you continue on your quest to becoming an expert trader. From the beginning, I was skeptical about the analysis that treated all prices as equal. After years in the markets with the membership of the Chicago Board of Trade and founding member of the Chicago Board Options Exchange, I came to the conclusion that the fundamental analysis is generally too long-term, often appearing out of touch with the market. Auction market theory, on the other hand, seemed to offer the most objective means of allocating a constant flow of bids and offers. I embraced that idea that auctions are really mechanisms for price discovery. For example, if an auctioneer couldn't get buyers to raise their bids as he was attempting to get the auction underway, he would lower the bid. Once the auction got going, it usually took one of two courses. If the auction occurred as expected, rising prices would indicate that some bidders had their orders filled while others dropped out as prices increased. Eventually, the auction would end as the last bidder bid. Volume decreases as prices rose. This was the expected course as higher prices were cutting off buyers. The unexpected auction was far more complex and exciting. As prices auctioned higher, volume increased, with new bidders continually entering the market. These kinds of auctions often end with an upward flurry as the laggards arrive. Once I was introduced to the Gladwell's diffusion model, I more fully appreciated the auction process in all of its nuances. It was a much smaller step to grasp the concepts of a continuous two-way auction process, auctioning from high to low and low to high, than to consider the influence of the different participants on the auction process. The market profile served as an innovative way to organize these continual two-way auctions in such a way that specific participant behavior could sometimes be visualized. I'm often asked if the profile works, or, more commonly, if it still works. The better question is the market profile a valid scientific way to organize data? The answer to that question is a definitive yes. The profile is constructed using a constant, time, on the horizontal axis and a variable, price, on the vertical axis to form a distribution. Scientists have employed this method to study and observe data for generations. Personally, I would much rather study organized data than unorganized data. The profile is simply a valuable tool for organizing objective information. To be clear, I'm a trader, not a profile trader. However, the profile has been invaluable to my analysis, and it has enabled my personal evolution through decades of reading and interpreting data in its ever-changing visualizations. The previous discussion around the tails is a good example of how the profile has enabled deeper insight into the patterns of human behavior that often emerge. Over time, our knowledge deepens through practice, and not just practice, but correct practice. Remember the golf swing metaphor. Hierarchy of information. When we began to learn any skill to start with basic definitions, as time goes on, we will begin to internalize these basics. Then, as we become competent, we have internalized enough information to, for example, play the piano well enough that the piece can be recognized by a patient listener. We are not alone at this stage. Countless would-be artists can play the same tune well enough to be recognizable. In short, our skill level has no meaningful revenue potential at this stage. Reflect on how easy it has become for most of us to drive ourselves to the store. Yet, we're still nowhere close to becoming a race car driver or a New York City or New York taxi driver. If we want to advance professionally, once the basics have been acquired, we must continue to practice, learning one nuance at a time. Setbacks, of course, occur when we have acquired so many nuances that we have to begin to decide which are more important, as well when a particular nuance becomes irrelevant under changing conditions. Think of this as a ruling reason. For example, you may have 6 data points that suggest positive bias for price direction, but one observation that points to negative bias outweighs those 6. It is the ruling reason that drives your decision. As you advance toward proficient and expert, the information that is most salient within the current context becomes easier to discern. A professional baseball coach doesn't routinely have his players attempt to steal home, but under the right circumstances, the risk to reward may be attractive enough to attempt such a bold gambit. Most successful professionals have identified multiple mentors and constantly look to coaches to keep them on track. But finding a coach that is truly knowledgeable and affordable is prohibited for most people, traders included. Prohibitive, my bad. Below we have attempted to list many of the nuances that you must deal with every day. And while listing and describing them is far easier than internalizing them, we believe that once you have these nuances in mind, you will be in a better position to constantly observe them, honing your ability to effectively employ them as part of a trading strategy. An important part of internalization process includes recognizing the changing hierarchy of the subtle information from day to day. We got about 15 minutes left till the FOMC comes out. Let's keep powering through. Time frame control. Who is dominating the current session? It'll be more practical in the early stages of your career if you think in terms of the day time frame and then all the others. But as you become more experienced, you'll begin to see 4 time frames: day, short term, intermediate term, and long term. On days when the day time frame is in control, the trading is likely to be restrained with lower volume, less range extension, and guided by very mechanical references. Among these references, number 1, the opening, which may be the day time frame guide for the entire day. 2, half back, which is simply the center of the range and provides a dynamic reference point that changes as the daily range extends on the high or low. Unchanged, or unched in trader lingo, which is simply the settle of the previous day. Additionally, the high and low from the overnight trading, as well as the previous day, week, and month, will be very much in play. Weekly highs and lows are only relevant to the day trader if they are easily within range. When the day time frame is in control, you are far more likely to experience non-excess highs and lows, which simply indicate lack of buying or selling tails. We also refer to those as poor or unsecured lows and highs. During these days, you are much more likely to see day time frame inventory become too short or too long, with constant counter auctions to correct the day time frame inventory imbalance. When the other time frame is in control, the references listed above will be far less significant. In fact, long-term traders may not even acknowledge some of them as references. Day time frame traders attempting to apply those references or anchors when the other time frames are in control are likely to get run over. How many times have we heard day and short-term traders say that they gave back 3 weeks of profitable trading in one day? Right? Didn't bring this up this morning for no reason. Many times we've also heard it, if it weren't for that one day, my month would have been profitable. It is crucial to day and short-term traders to respect the dominance of longer time frames, who always trump the actions of shorter time frames. The other time frame is more likely to recognize a multiple day trading range, interchangeable terms and balance areas or trading brackets, highs and lows, weekly and monthly extremes, unfilled gaps, and common knowledge moving averages. More alert and experienced day time frame traders who are able to quickly recognize who's in control pile on to the auction driven by the longer time frame. These adaptable day traders shift their strategy and tactics from more mundane rotational trading to momentum trading. The less experienced day trader is fading or going against the auction of the longer time frames. The addiction to price, that temptation to sell a price higher than they could previously or buy at a price lower that they could previously, cannot be resisted. They step in front of a proverbial train. Markets are visual. A standard bar chart is the best way to identify visual references, such as trading range highs and lows, as well as weekly and monthly extremes. Most people have a tendency to view the 24-hour electronic bar chart rather than view a bar chart that includes the pit sessions only. As of this writing, the New York or Chicago pit sessions are still the center of trading for most US listed equities and world commodities. For this reason, we may view a bar chart for the US pit session and may separately view a 24-hour bar charts, particularly for currencies. We do this so that we can view gaps between the US day sessions. We define a gap as an opening that occurs outside of the previous day's high or low. We don't measure gaps from the close of the prior day, right? We call that a shadow trader gap. We also view the US session day bar charts for the daily, weekly, and monthly trading ranges and excess highs and lows. This affords us an opportunity to see visual areas on bar charts that may be destinations for current directional auctions, hereafter referred to as destination trades. We are often asked why we use bar charts rather than a composite profile for long-term charts. The reason is that long-term composite profiles contain too much information and hide important structural information such as gaps and trading range highs and lows. We just discussed additionally significant reference points such as the daily, weekly, and monthly highs and lows may blend into a composite where they are lost. And I think that is where we will stop today. We don't have too much left, so we will finish up the rest tomorrow. Appreciate everyone stopping by for the read, and you guys have a wonderful rest of your day on YouTube. You're trading, make sure that you are managing risk and sticking to your trade plan, and I will see you guys tomorrow.